Hey everyone, welcome back to my Wealth Builders Realty. I'm Sylvia Christensen, and if you're here, it probably means you're serious about growing your real estate portfolio or making a smart move on your next home purchase. Today, we're diving into a topic that most investors and even homeowners overlook: the types of real estate financing available and how to actually use them to your advantage. Whether you're a first-time buyer, a seasoned investor, or someone stuck in the I don't know which loan makes sense stage, this video is for you. I'm going to break down the pros and cons of different loan types, how they fit into your financial picture, and when it might make sense to combine strategies. We'll cover everything from qualified mortgage to non-qualified mortgages, DTI requirements, interest rate differences, and the fees no one talks about. Plus, some real-world tips on how to use your financing strategically for long-term wealth building. Because I believe your time is valuable, you can now skip ahead or jump back using the time codes below. Ready? Let's get into it. Before we jump into specific loan types, there's one major concept you need to understand first: the difference between qualified mortgages and non-qualified mortgages. Qualified mortgages are loans that follow the rules set by the government, specifically something known as the ability to repay rule. These loans are underwritten with strict guidelines around things like your debt to income ratio, full financial documentation, and fee limits. In other words, these are your traditional loans: conventional, FHA, VA, and USDA. They're predictable, they're safe, and they usually offer the best terms and rates. Non-QM loans, on the other hand, are built for flexibility. They're designed for borrowers who don't fit neatly into that traditional lending box. Think real estate investors, self-employed business owners, and people with non-standard income streams. Here's the catch though: non-QM loans usually come with higher interest rates, bigger down payment requirements, and higher fees. But in return, they open up access to financing when QM options just don't work. So you might be a W-2 employee with great income and great credit, wondering why you should even care about non-QM loans if they will offer you higher rates and less advantageous terms. Well, as you grow your real estate portfolio, you might need to move beyond the safe and simple QM options. The fact of the matter is that QM uses DTI, and the more debt you accrue as you grow your real estate empire, the less appealing you become to traditional lenders. That's where knowing how to use non-QM loans strategically can help you grow smarter and faster without getting stuck or overextended. Before jumping into strategy, let's first talk about the most common loan types and how they line up in this QM versus non-QM world. Let's start with the most familiar category: traditional mortgage loans. These include your conventional, FHA, VA, and USDA loans. I'm sure you've heard these terms thrown around. They all fall under the qualified mortgage umbrella, meaning they follow strict federal guidelines to protect both you and the lender. Conventional loans are the most commonly used type of financing for both primary homes and investment properties. If you have solid credit, stable income, and a decent down payment, this is often your most affordable option. You can get into a primary home with as little as 3% down, while an investment property will be closer to 20%. Not too long ago, I had many lenders that only required 15% on these investment loans. Depending on market conditions, these can fluctuate, so check with your preferred lender. And if you're looking for one in the Boise metro area of Idaho, reach out for a curated list of the best lenders we work with. Now, if your credit's not quite there or you need help with the down payment, there are other options. Enter the FHA loan. Contrary to popular belief, FHA loans aren't only for first-time home buyers. These loans are backed by the government and designed to help first-time or lower credit borrowers get into a home. You can put down as little as 3.5%, and they're more forgiving on credit scores, even down to 580 in some cases. Best of all, you can use an FHA loan to purchase a multifamily property up to 4 units if you plan to live in one of the units. Yep, you heard that right. You can put down only 3.5% down and buy that fourplex. I cover exactly how to do this in this video. I will also put the link in the description below. FHA can be a great entry point, especially if you're just starting out, but it's not ideal for investment purchase or long-term cost savings due to the mortgage insurance requirement. Not only do they hit you with a monthly mortgage premium, but you also get dinged up front, leading to higher closing costs. And even if you get to the 22% equity mark, getting out of that PMI means refinancing. VA loans are an incredible benefit for active duty service members, veterans, and some military spouses. These loans require no down payment and no mortgage insurance, which can mean huge savings. And like FHA, You can use a VA loan to house hack your way into financial freedom. Buy up to a fourplex with your VA loan and live in one of the units for a year. A quick note here on VA entitlement, which is how much the VA guarantees on your loan. If you move out of the fourplex and want to use a VA loan to purchase your next primary residence, you will need to check how much entitlement benefit you have remaining. Depending on what you have, you might be required to put a down payment on your new purchase or even refinance the fourplex into conventional financing. Still, if you're strategic about when you start your new purchase, you might have some extra equity in your current fourplex to sweeten the move. If you're a qualifying veteran, this should always be one of the first options you explore. USDA loans are for low to moderate income buyers purchasing in eligible rural areas. But having low income or moving to the outskirts of town doesn't mean you're excluded from the investor club. And you'd be surprised at how many places qualify for this type of financing. In our Boise metro area, you can look into towns like Caldwell, Middleton, and Marcy. And if you thought these areas were in the boonies with nothing to do, you couldn't be further from the truth. Canyon and Oahe counties are known for the Snake River, Lake Lowell, hiking trails, and Idaho's own wine country. Living in the outskirts of town doesn't mean only farming. USDA loans are niche, but if you're buying in a qualifying area and meet the income guidelines, they can make homeownership and even calculated investment much more accessible. While you cannot use a USDA loan for investment purposes from the get-go, it can be a tactical move for short-term rentals in the future. In our Caldwell example, frequent visitors to Idaho love to take advantage of our water activities provided by the nearby river and lake. Further, consider this. The fact of the matter is that rural areas and rural properties usually come with less stringent CC&Rs, if any at all, and the potential for more usable land, both of which are conducive to building an ADU or even renting out the land to farmers and animal owners who need somewhere to board their horse, thus converting that primary home into a savvy investment vehicle. As you can see, being deliberate about your investment goals and knowing which tool to use has major advantages. Okay, so that's your overview of QM loans. Reliable, affordable, predictable, if you qualify. What if your situation doesn't fit neatly into that traditional box? That's where non-QM financing comes in. Let's take a look at the most common non-QM loans and how to use them without putting your future financing at risk. Non-QM doesn't mean risky or shady. It just means the loan doesn't meet the strict qualified mortgage guidelines that we talked about earlier. You still need to qualify, but these loans look at different factors to determine your ability to repay. One of the most common investor-friendly loans available are DSCR loans. These focus on the income the property itself generates, not your personal income. If the rent covers the mortgage, you're in business. Thus, they don't look at any of your personal finances. No tax returns, no pay stubs, no bank statements. DSCR loans are powerful for investors who want to scale, even if their personal income wouldn't qualify them for traditional loans. Next, we have bank statement loans. These are ideal for self-employed buyers who don't show consistent income on their tax returns. Instead of W-2s and tax returns, lenders use 12 to 24 months of personal or business bank statements to assess cash flow. If you have a business and pay taxes only on the taxable income, then your goal is to make tons of money, but also take 1 million tax deductions to show less income that will then be taxed. Unfortunately, this means that when your QM lender looks at your income tax returns, they make the determination that you are a pauper and would never fit the ability to repay guidelines they have. So if you're a business owner and want to buy a property, do you take less deductions, pay higher tax just so you can show income and buy a property? You can do your own math with the help of your accountant. But if you don't want to bother with that, you can check out bank statement loans. Now, this next one I was not personally familiar with. I'm talking about asset-based loans. These loans are perfect for high net worth individuals who don't have strong income but have significant liquid assets that can be used as collateral. These loans qualify you based on what you have, not what you earn. Retired on a fixed income? No problem. Trust fund baby waiting for that benefactor to die? No problem. So if you thought your age or retirement barred you from the investment game, think again. Last on my list are interest-only loans like HELOCs. You can pull a HELOC or a home equity line of credit on your personal residence, which is the most common. However, I am finding it increasingly common to see lenders who offer HELOCs on investment properties as well. These loans allow you to pay only the interest for a set period, which lowers your monthly payment. Great for managing cash flow, especially on investment property. And because they function sort of like a credit card, you can use the money, pay it back, and have it available to use on your next purchase. That being said, tread carefully with HELOCs. If you pull one on your primary home, keep in mind that that home is the collateral. And when you are sticking with interest only, these are also usually adjustable rates, meaning your monthly payment can fluctuate, leading to inconsistent cash flow from your rentals. As you can see, non-QM loans give you options when traditional financing says no. This flexibility does come at a price, usually in the form of higher rates, fees, and stricter reserve requirements. That's why you don't want to jump into non-QM financing without a plan. Used correctly, it can unlock doors and help you grow, but used too early or in the wrong order, it can box you out of cheaper loans in the future. With that in mind, let's talk about how to strategically use and even combine these loans. Let's dig into something that's rarely talked about, but incredibly important if you're planning to buy multiple properties: the order in which you use different types of financing. Used wisely, a non-QM loan like a DSCR or bank statement can absolutely unlock doors for you. For example, let's say you find a great investment property, but you just left your W-2 job to become self-employed. You won't qualify for a conventional loan for another year or two while you build up your income history. A DSCR loan could let you grab that property now based on its rental income, not your tax returns. In that case, using non-QM first unlocks opportunities. But here's the flip side, and this is where a lot of investors get tripped up. If you lean on non-QM financing too early or too often, you could actually box yourself out of more affordable loans down the line. Here's two ways how that happens. First, higher rates and payments affect your global DTI. Even though a DSCR loan doesn't calculate DTI for that deal, your future conventional lender will look at that mortgage payment. And higher non-QM payment could push your total monthly obligations too high for a new conventional loan. And number two, asset depletion or liquidity lockup. Many non-QM products require larger down payments, sometimes 20 to 25% or more. If you drain your reserves too early using non-QM, you might not have enough liquid assets left to qualify for a more favorable QM loan later. Keep this in mind as you compare loans for FHA to bank statements, for example, for that duplex. Here's the takeaway. Non-QM financing is a tool, not a strategy. It's great when used intentionally to bridge a gap or take advantage of unique opportunities. But if you rely on it too early or use it as your go-to for every deal, it can limit your flexibility and cost you more long-term. When possible, always start with the QM loan. It will get the job done with less fees, lower rates, and sometimes less money down. And that can be very favorable when it comes to combining loans. My husband and I bought our first investment property with a conventional loan. As the equity in that property grew, I set up a HELOC, interest only, and used that line of credit as a down payment piggy bank for our next investments. And as those investments grew in equity, we did the same thing with them. Now, this isn't an overnight thing, it's a long-term play. Friends, at the end of the day, real estate financing isn't one size fits all. It's a toolkit, and when you understand which tool matches your income, credit, and long-term goals, you stop reacting and start strategically building wealth. If you'd like help figuring out your best next step, reach out. My team and I specialize in guiding clients through this financing maze so they can buy smart, build wisely, and grow with confidence. If this video helped you, be sure to like, subscribe, and leave a comment with your financing questions below. And I'll see you on the next video. Thanks for watching.